This is exactly what happens to every dollar in your account the moment your bank fails. From the secret Friday night takeover you've never heard of, to the 90-year-old safety net that has never once let an insured depositor lose a single penny. By the end of this video, you'll know how to structure your account so that even if the worst happens, your money is fine. Because in March of 2023, the worst did happen, and it happened faster than anyone thought possible. Silicon Valley Bank, the 16th largest bank in the United States with roughly $209 billion in assets, dropped a bombshell after the market closed on Wednesday, March 8, 2023. They'd sold their $21 billion bond portfolio at an after-tax loss of $1.8 billion and announced plans to raise $2.25 billion in new equity to plug the hole. That announcement was supposed to restore confidence, and instead it detonated. SVB had loaded up on long-duration treasury bonds and mortgage-backed securities during the pandemic boom, back when interest rates sat near zero. As the Fed hiked rates through 2022, the market value of those bonds cratered. By year-end 2022, SVB carried roughly $15.2 billion in unrealized losses on their held-to-maturity portfolio alone, plus another $2.5 billion on their available-for-sale securities. Management had also removed their interest rate hedges while rates were climbing, which the Federal Reserve's own Inspector General later called a significant error by SVB management. Moody's downgraded SVB that Wednesday night, and venture capital firms, including Peter Thiel's Founders Fund, started telling their portfolio companies to pull their money out. By Thursday morning, a digital stampede had begun. $42 billion left the bank in a single day. That's roughly 25% of SVB's total deposits gone in hours. Another $100 billion was queued up for withdrawal Friday morning. Compare that to Continental Illinois in 1984, the collapse that literally coined the phrase too big to fail, where roughly 30% of funding drained over 10 days. SVB lost 25% in one, and that is what happens when bank runs move at the speed of a group chat. Federal Reserve Vice Chair Michael Barr put it plainly. The combination of social media, a highly networked and concentrated depositor base, and technology may have fundamentally changed the speed of bank runs. Between March 8th and 14th of 2023, researchers counted over 6,500 tweets with the word run about SVB and nearly 10,000 contagion tweets. This wasn't a line around the block. It was a bank run conducted through Slack channels, WhatsApp threads, and tweets seen by millions. By Friday morning, March 10th, SVB could no longer fund the day's withdrawals, and the California Department of Financial Protection and Innovation shut the bank down and handed it to the FDIC. But here's the thing, what happened next wasn't chaos. What happened next was a very specific, very rehearsed process that the FDIC has been perfecting for 90 years. Between 1929 and 1933, nearly 10,000 American banks failed, more than one-third of every bank in the country. 1933 alone saw about 4,000 bank suspensions. There was no safety net, no backup plan, and if your bank went under, your money was simply gone. Franklin Roosevelt declared a national bank holiday on March 6, 1933, shutting down every bank in the country. Congress then passed the Emergency Banking Act, in what might be the fastest piece of major legislation in American history, with the only copy of the bill held on the House floor by Representative Henry Steagall, who reportedly shouted, "Here's the bill, let's pass it." 40 minutes of debate, no amendments, and the bill was law. FDR himself was skeptical of deposit insurance. His words were, "We do not wish to make the United States government liable for the mistakes and errors of individual banks and put a premium on unsound banking in the future." Congress pushed it through anyway. The Banking Act of 1933 was signed on June 16th, and the FDIC began insuring deposits on January 1st, 1934. After more than 9,000 bank failures in the preceding 4 years, only 9 banks failed in 1934, which tells you everything about the immediate effect. And here's the detail that makes this real. A 66-year-old woman named Lydia Lobsiger walked into a bank in East Peoria, Illinois on July 5, 1934, wearing a freshly laundered gingham dress and a black straw hat holding her 3-year-old granddaughter. She collected the very first FDIC insurance payment, a check for $1,250, after the Fond du Lac State Bank had failed. The first thing she did was walk to the only other bank in town and open a new account. That is what deposit insurance is. Not an abstract policy, but the reason that woman could trust a bank again. Since January 1st, 1934, no insured depositor has ever lost a single penny. Not during World War II, not during the savings and loan crisis, not during the 2008 financial crisis, not during 2023, not once. Coverage sits at $250,000 per depositor, per insured bank, per ownership category. That limit started at $2,500 in 1934. It climbed to $5,000 later that year, then $10,000 in 1950, and gradually reached $100,000 by 1980. Dodd-Frank made the current $250,000 limit permanent in 2010. What most people don't realize is how broad that coverage already is. As of December 2022, more than 99% of all deposit accounts in the United States fell under the $250,000 limit, which means the vast majority of people already have every dollar protected. The money behind this guarantee lives in the Deposit Insurance Fund, the DIF. As of the fourth quarter of 2025, the fund held $153.9 billion. The reserve ratio stood at 1.42%, comfortably above the 1.35% statutory minimum. Banks fund it through assessments they pay, plus interest on Treasury securities, and behind the fund stands a $100 billion line of credit with the U.S. Treasury that has never been tapped. That fund has been tested hard. During the 2008 crisis, the DIF balance fell to negative $20.9 billion. By the end of 2009, recovered by 2011 and reached its statutory target by 2018. The system bent under the pressure, but it didn't break. Right now, the FDIC insures 4,336 institutions, with 60 of them sitting on the problem bank list, about 1.4%. For context, that list peaked at almost 900 banks in early 2011 during the financial crisis. About 6 FDIC closure groups based in Dallas handle bank shutdowns. Once a team gets assigned to a bank, they spend roughly 90 days in secret analyzing assets, segmenting deposits, and scouting potential buyers. No advance notice reaches the public, none at all. Banks are typically closed on a Friday evening for a specific reason. It gives the FDIC the entire weekend to execute the transition. Around 100 staff arrive at the bank, and for institutions over $1 billion in assets, that number can reach 200, with examiners stationed at every single branch. Locks get changed, IT systems get taken over, new signage goes up, and by Monday morning, the acquiring bank's operations are ready to go. 3 main resolution paths exist for a failed bank. The most common is a purchase and assumption, where a healthy bank buys the failed bank's deposits and often its loans. Branches reopen the next business day under a new name, and your account, your debit card, your direct deposit all transfer over. Most people who experience a bank failure barely notice it happened. When no buyer steps up, the FDIC does a deposit payoff, paying insured depositors directly either by check or through a temporary institution called a Deposit Insurance National Bank, with the goal of getting that money out within 2 business days. And then there's the Bridge Bank, a temporary federally operated institution that keeps the lights on while a buyer is found, which is exactly what happened with SVB. The FDIC created Silicon Valley Bridge Bank, N.A., on March 10, 2023, and by Monday the 13th, depositors had full access to their money. That Friday-to-Monday turnaround is the design. That is the whole point. Here's where the story gets complicated. If you held more than $250,000 in a single ownership category at a single bank, and many of SVB's customers did, the math changes completely. An estimated 88 to 89% of SVB's deposits were uninsured. This was a bank serving tech companies and venture-backed startups, not individual savers. And these were corporate operating accounts with millions of dollars in them, used to make payroll and pay vendors. Under normal circumstances, uninsured deposits become creditor claims against the failed bank's receivership estate. The FDIC historically issues advance dividends to uninsured depositors in the range of 50 to 80 cents on the dollar. A 2014 FDIC study analyzing more than 1,000 bank failures from 1986 through 2007 found that uninsured depositors lost an average of roughly 27% of their claim, with an average receivership lasting about 5 years. The typical experience for an uninsured depositor means getting most of your money back, but not all, and waiting years for it. That is not what happened with SVB. Just 2 days after SVB closed, on Sunday evening, March 12th, the Treasury Department, the Federal Reserve, and the FDIC jointly invoked the systemic risk exception, an emergency provision allowing the FDIC to protect all deposits at a failed bank, not just insured ones, when regulators determine the failure poses a systemic risk to the financial system. Signature Bank received the same determination that Sunday. New York regulators had shut it down that same day, and Signature was the 29th largest bank in the country with about $110 billion in assets, heavy crypto exposure, and somewhere between 67 and 90% of its deposits uninsured depending on when you measure. At the same time, the Fed launched the Bank Term Funding Program, letting banks borrow against Treasury bonds and mortgage-backed securities at par value instead of their depressed market price, which acted as a pressure release valve for every other bank sitting on similar unrealized losses. President Biden addressed the country Monday morning. Americans can rest assured that our banking system is safe. Your deposits are safe. 2 months later, it happened again. First Republic Bank, a wealth-focused institution with $229 billion in assets, making it the second largest bank failure in U.S. history, was closed on May 1st and sold to J.P. Morgan Chase in a weekend auction. First Republic had lost about 40% of its deposits in the first quarter of 2023, even after 11 major banks deposited $30 billion there in a coordinated rescue attempt. All depositors at all three banks were made whole, but here's what you need to understand. That outcome was not normal. The systemic risk exception is the exception. It required the Treasury Secretary, the Fed, and the FDIC board to all agree that these specific failures threatened the broader financial system. The Government Accountability Office later flagged the moral hazard directly. Protecting all deposits can create moral hazard by reducing bank and depositor incentives to manage risk, as they may expect future bailouts. You should not plan your finances around being bailed out. The government was clear that no taxpayer money was used, but somebody paid. The FDIC imposed a special assessment on banks holding more than $5 billion in uninsured deposits, with the total bill estimated at $16.7 billion as of September 2025. 8 quarterly payments started in the first quarter of 2024, and the final payment was due March 30th, 2026. The largest banks absorbed the largest charges. J.P. Morgan accrued approximately $2.9 billion, Bank of America about $2.1 billion, Wells Fargo $1.9 billion, and Citigroup $1.7 billion. Those costs inevitably get passed along through fees, through rates, and through the broader cost of doing business with banks. When people say the taxpayer didn't pay, that is technically true. The banking system paid, and you are a customer of the banking system. One thing people always wonder is whether their mortgage vanishes if their bank fails, and the answer is no. The FDIC's own borrower's guide states directly, the terms of your loan will not change because they are contractually agreed to in your promissory note. Your obligation to pay continues exactly as before. What changes is who receives your payment. Usually the assuming bank takes over your loan alongside your deposits, which is what J.P. Morgan did with both WAMU and First Republic loans. If nobody assumes the loan, the FDIC may sell the portfolio or handle collections directly. Keep making payments to the same address until you receive official notice of a transfer, watch for a servicing transfer notice, and know that lines of credit and home equity lines may be frozen during the transition. The FDIC will not lend new money. After everything we've covered, here's the practical takeaway. The FDIC insures $250,000 per depositor, per insured bank, per ownership category, and that last part, the ownership category, is where the math gets interesting. A married couple at a single bank can carry up to $1 million fully insured, $250,000 in each spouse's individual account, plus $500,000 in a joint account at $250,000 per co-owner. $1 million total, all covered at one bank. Pushing that number higher is possible. Revocable trust accounts naming distinct beneficiaries add $250,000 per beneficiary, up to $1.25 million per owner. Each spouse's IRA gets its own separate $250,000, and business accounts are counted separately from personal ones. For deposits well beyond those limits, a network called Intra-Fi formerly CDARS, includes more than 3,000 financial institutions, roughly 3/4 of all U.S. commercial banks and thrifts. You deposit at your bank, and IntraFi automatically splits the money into chunks under $250,000 placed at multiple network banks, each individually FDIC insured, giving you one bank relationship with multi-million-dollar coverage. The simplest approach is also the most obvious. Use more than one bank. Different branches of the same bank do not count separately, so Chase in New York and Chase in LA are the same institution. Accounts at separately chartered banks each get their own $250,000 in coverage. The FDIC offers a free online calculator called the Electronic Deposit Insurance Estimator, or EDIE, at ed.fdic.gov. You plug in your account structure and it shows you precisely how much is covered. Do that today. Since the FDIC began operations on January 1, 1934, this system has survived the Great Depression, the savings and loan crisis, the 2008 financial crisis, and the 2023 banking panic. 572 banks have failed since 2001 alone, and during the worst of the financial crisis, 157 went down in a single year, 2010. In over 90 years, no insured depositor has ever lost a penny. That is not a slogan, it is a track record. The system is not perfect. SVB proved that bank runs now happen at the speed of a tweet. A debate over raising deposit insurance limits is playing out in Congress right now with a bipartisan bill called the Main Street Depositor Protection Act that would raise coverage to $10 million for business transaction accounts, though as of May 2026, it still sits in the Senate Banking Committee. What matters for you is this. If your bank fails tomorrow and the odds remain low with only 60 banks on the problem bank list out of 4,336 total, a team in Dallas has probably been planning for it for 90 days. They'll show up on a Friday night, change the locks, transfer the systems, and find a buyer. By Monday morning, you'll walk into the same building, sit down at the same desk, and access your money, with the only difference being a new name on the door. That's the system Lydia Lobsiger made possible in 1934, when she walked into a bank in East Peoria in a gingham dress, collected a $1,250 check, and opened an account across the street. 90 years later, it still works. If you want to understand how banks make money off of you in the first place, and why they're designed to keep you just a little bit bad with money, watch this video next.